Evening, esteemed participants and distinguished speakers. On behalf of the Indo-American Chamber of Commerce, it gives me great pleasure to welcome you all to this insightful webinar where we will be discussing the guide to growing your business in the United States of America. The USA, as we all know, is an economic powerhouse, the largest economy in the world, offering endless opportunities for entrepreneurs and business leaders. However, navigating the complexities of this vast market can be quite challenging. That is why we have organized this webinar to provide you with the necessary knowledge and guidance to successfully expand your business in the USA. During this webinar, we will be addressing crucial topics such as market analysis, legal considerations, cultural nuances, marketing strategies, and financial planning. Our aim is to equip you with practical insights and actionable steps that will pave the way for your business growth and success. We have a very eminent speaker, Mr. Kris Sharma, who is the owner and president of Orbit Institutes Private Limited, USIndiaTax Inc., who brings a wealth of experience and expertise to this discussion. I encourage you to actively engage with our speakers, ask questions, and make the most of their insight. Shortly, I would invite Mr. Akhil Chandna, who is the partner and leader, Global People Solutions at Grant Thornton, to introduce our guest speaker and also to deliver the theme address. Now, we have to remember that expanding our business to a foreign market requires careful planning, adaptability, and a willingness to embrace new challenges. The US market definitely offers vast potential, but it also demands a deep understanding of its consumers, trends, and regulatory environment. By leveraging the knowledge shared in this webinar, you will be better equipped to make informed decisions and seize opportunities. I would like to express my heartfelt thanks to our organizing team, Neelu Sadana, Kashish Tyagi, and the crew for their tireless efforts in putting together this event. I also extend my gratitude to our esteemed speakers who generously accepted our invitation to share their expertise. Their contributions will undoubtedly enrich this webinar. Last but not the least, I want to thank every one of you for joining us today. Once again, welcome to this webinar on the guide to growing your business in the USA. Let's embark on this transformative journey together. And now let me introduce Mr. Akhil Chandna, who is leading the Global People Solutions practice at Grant Thornton. He's got 16 years of experience in advising the clients in diverse areas of business tax and regulatory matters, including corporate tax, cross-border taxation, corporate restructuring, and employee-related matters across tax, social security, and labor laws. He's leading the firm's initiative to develop solutions around the social security, as well as the new labor codes proposed for implementation by the government. He's a regular speaker at Northern India Regional Council of the Institute of Chartered Accountants of India and other forums like CII, SOCHAM, etc. He's a qualified chartered accountant and also holds a degree in law. Over to you, Mr. Akhil Chandna.
Thanks, Mr. Khanna. It was such a nice opening, and I can say that the kind of energy you bring in, let's hope that we have the same kind of energy and engagement with the people. So before I'll introduce to our speaker for the day, let me give you some brief facts about India and US partnership. As everyone knows, it's a comprehensive global strategic partnership which has taken its different heights by way of continuous communication and high-level visits. We've seen off lately, and this has strengthened the bilateral ties between them. Just to give you a perspective, US is India's largest trading partner, with bilateral trade in goods and services crossing USD 191 billion in 2022. And US is amongst all the FDI coming into India, is the third largest source of FDI, with inflow of US $6.04 billion, accounting for almost 9% of total FDI equity inflows in 2020-2023. and people will be glad to know, as per the CI study released in April 2023, 163 Indian companies invested over $40 billion in the US and created over 425,000 direct jobs. which gives immense pride that we, as an Indian, and the way we are investing and creating jobs in different geographies. As everyone knows that there have been bilateral cooperations in sectors such as space, health, education, and culture. US has a strong India diaspora. Almost 4.4 billion Indian origin people reside in the US. This has helped, strengthening our relationship and building, closer ties between India and US. There are several Indian startups, including Ola, Zomato, Hi, CleverTap, InMobi, Freshworks, which has expanded their operations in the US. This is due to their ability to build strong relationship partnership with local businesses and organizations and gaining valuable insights into the local market and access to funding and other sources. So this is an overview. This shows the kind of opportunity we are sitting on. And today, let me introduce Mr. Kris Sharma, who's the owner and president of Orbit Industries Private Limited, USIndiaTax Inc. Corporation. He has a multifunctional experience of 30 plus years in audit, accounts, finance, taxation, financial advisory services, both from India and US perspective. He's the president, Becker CPA review courses in India since 1997, responsible for the operations of 11 Becker CPA review centers across India. He will give us some kind of guidance around how we can, the way we've seen the companies are expanding in US, how we, also can look into that, the opportunities, the kind of landscape we have. And just before handing over to him, just to give you a perspective, he's been, training the instructors, managing the operations, and has a staff of over 100 CAs and CPAs and 40 plus administrative working from him. He's been training to the prominent, institutes like Deloitte, KPMG, EY, American Express, Bank of America, and so on. So over to you, Mr. Kris Sharma. Looking forward to have better insights and, clarity on how to move on this. Thank you.
Sure. Thank you, Arun, and thank you, everybody. A bit of my introduction has been given, but I've got a slide presentation. But so we can go to the first slide. Yeah. So we are, as Arun mentioned, we got 3 companies, but right now this is US. This seminar has been conducted under the banner of US India Tax. It's a C Corp. It's a CPA firm from the US with a back office in Pune. So next slide, please. So we can go to the next slide. Okay, next one. All right, let me start with my journey. My father was a teacher in India, and back just after independence in 1951, he was appointed as a principal of a school in Nairobi, Kenya. So my birthplace is Nairobi, Kenya, and I did my high school in Kenya. Then I came back to India. I did my BCom MBA CA from Punjab University, Chandigarh. I did not work in India, but then I went back to Nairobi, worked as a chief accountant for a manufacturer of biscuits and all. It was called House of Manji. And then 2 years later, I got engaged to a girl who's from India, but she was based in Canada. So I moved to Canada, got married there. So initially, for the first year, I did some random jobs, but then I felt that, I should become more qualified in Canada. I ended up doing my CGA in Canada, which is just like the Canadian CA program. I worked with the government as an auditor with the federal government, and also the state of Ontario. I worked as an auditor. And after working with them for 8 years, I left them and started my own practice as a tax consultant in Toronto. So while I was in my practice in 97, I decided to write my American CPA examination also. So I was a qualified accountant from India, from Canada, and just felt the need that I should, also add to that my US CPA qualification. So I wrote my US CPA examination in 97. I cleared that examination, and then things unfolded, so rapidly for me. So I was selected by a listed company on the New York Stock Exchange, which was called DeVry University. Now the name's changed. So DeVry's into a field of education. It's listed on the stock exchange. It's into medical education, nursing, technical courses. And one of the verticals of DeVry was Becker Professional Review. So I got the rights from DeVry to start the American CPA, Becker CPA Review in India. So that was how my journey into India started. And I came here in 97, and I started my first CPA coaching center in Delhi. And so I did everything basically. I did everything, right from, sort of interviewing the students, teaching and administration. And then after 6 months, I opened a center in Mumbai, and within 3 years, we had Orbit Institutes, which is the education company, having centers all over India, in almost every big city of India. We also had associations with, leading companies like American Express, Deloitte, KPMG, Pricewaterhouse, Genpact, Accenture. So we started conducting training courses for CPA for them. So also at that time, one was coaching for the CPA examination. We also got into corporate training. And I remember long ago, with some joint sessions with Indo-American and conducted seminars on US GAAP and other courses also. So then in about 2005, I started USIndiaTax, which is a C Corp, a CPA firm from the US, registered as a private limited company, which is a C Corp. And so the company was there, and the back office of that company today is in Pune. It's been in Pune for so long. So right from I would say about 2005, I have USIndiaTax with a back office in Pune. Very skilled staff, by virtue of the fact that I was handling Orbit. So all my student database, all my instructors were qualified. Quite a lot of them were taking the CPA training. Some already got qualified. So Orbit Institutes and USIndiaTax has a wealth of, skilled staff who are very, very conversant with, US accounting principles, UX tax compliance, and all the stuff. So then I moved from Canada. I moved to the US in 2002. So I'm a Canadian citizen. I'm a US citizen. I have another CPA firm in New Jersey. That's where I'm based, and that's called Sharma Marcus and Associates, which basically caters to the same kind of work, but more for clients based in the US. So that's been my journey all along. And what I felt, handling both education and the CPA practice, I felt that there was a lot of companies, a lot of individuals who wanted. We've been doing consulting on one-to-one basis. Somebody had a question, or somebody wanted a consulting session. We would conduct that consulting. But I felt that there was a lot of gap with the clients, with companies, with individuals, trying to really get a threshold and a total handling of what was US tax compliance. And that's what triggered this particular seminar. So though we've been doing it for a long time, but on a broader level, on a broader extent, we conducted it with Indo-American about 6 months ago in Chennai. That was a Zoom session, but now I'm doing a live session there on 13th. So there's going to be a live session with Indo-American on the same topic in Chennai on the 13th of this month. So that's my background. Could we have the next slide, please? Okay. As I mentioned, USIndiaTax, this is a CPA firm with a back office in Pune. We do everything. Like, we do tax advisory, we do tax planning, we do accounting, bookkeeping, setting up companies and corporations. And very recently, we have added. Now, India is the hub of a lot of back office work. And when we talk of back office work, connected with the fields that we are in, like accounting, finance, taxation. So there's a lot of back office work. We have audit support services offered from India to a lot of CPA firms based in the US. They need help with skilled talent who can prepare their working papers to support their audit opinions. There's a lot of tax preparation on a very conservative number. I mean, I can tell you that almost like 35 to 40% of US tax returns of a lot of big companies are being handled in India. And then, how do you go into US? What is the kind of structures that you have? What are the tax benefits, or how you can take all that stuff here? So that's about USIndiaTax. Can the next slide, please? Okay, Orbit Institutes, as I mentioned to you, we are the pioneers of bringing CPA to India. We are a part of DeVry, handling the Becker CPA review course. We came here in '97. We have Orbit centers in 12 cities in India. Now, along with the US CPA, we also offer Canadian CPA. We offer the CMA. We CFA and Diploma IFRS. I'm also a Diploma IFRS certified. So that's not on a very big scale. On a small curtailed scale, we offer the CPA, a CFA, and the Diploma IFRS also. And we also do a very we have a very large training division. Training division in any kind of training knowledges. I remember I've worked with a lot of companies in India who wanted to go public in the US. How do you list on NASDAQ? What are the Securities Exchange compliance requirements? Knowledge of US accounting principles, and finance. What is the difference between Indian GAAP and US GAAP? We also assisted a lot of Indian companies in converting their accounts of US subsidiaries from Indian GAAP to US GAAP and all this stuff. And then, of course, the whole training division of US GAAP. We have very recently added a new division to our company. Now, Orbit Educational Institutes, with an incorporation in '97, you can look at it, we are about 27 years of experience. So now the name stays the same. It's Orbit Educational Institute Private Limited, but it will be doing business as DBA as Orbit Education and Business Solutions. So in Orbit Education, we are offering all these courses. And also we have started, what I did observe for a long time was, today everything is virtual. So basically a lot of clients in the US want to get their accounts processed here or their tax returns processed here. So we have started under Orbit Education. We have the CPA course, the CMA course, the Canadian CPA course. We have these ones. And as a part of Orbit Education, we've also started Orbit Staffing. So we will be training a lot of Indian graduates, undergraduates in basic skills relating to US accounting, knowledge of QuickBooks, preparation of individual returns, entity returns and all that stuff. And we would also be tying up with a lot of companies in India and also US to place these people. A whole bunch of Indian graduates based in India could be handling and preparing US tax returns through this virtual mode of education. So that's a new division that we have started under Orbit Education. Under Orbit Business Solutions, Orbit Institutes is a back office for taxation, accounting, financial advisory, taxation, accounting, bookkeeping, tax return preparation. Also, we'll be meeting the human resource needs of a lot of companies. We'll be doing corporate training in US GAAP, US taxation, SOX compliance, audit, back office for audit supports, accounting, bookkeeping. And the last one is consulting, financial consulting. Anybody who wants to enter into the markets, enter to the US markets or Indian markets, what sort of compliance requirements they'll be looking at, what do they need to do, feasibility studies. So that is going to be all under Orbit Solutions. So Orbit Institutes will be operating and doing business as Orbit Education and Orbit Business Solutions. So we can go to the next slide, please. Okay, today's topic, as I mentioned to you, a lot of companies were not fully, compliant with or knowledgeable about, what kind of business structures do we have? How do they differ from business structures in India what are the compliance requirements at the federal, state, and local levels? How do we maximize our tax effectiveness, which also covers about getting tax refunds and tax credits, and also how do you get government grants and all that stuff here. And there's one point that's missing here, which is point 5, but we have a slide on that. It's not on this topic, is financing solutions. Like a lot of startups and other Indian companies, they might want to resort to financing. How do you get a loan from the Small Business Assistance, which is SBA under Section 7, which is a government agency. They give preferential rates to all that stuff. So as we go, deeper into the seminar, I'll be addressing each one of this in more detail. So can we go next slide, please? Okay. So the first thing is, how do you start a business in India? Okay. So one is that we have United States of America, which is at the federal level, but then we have 52 states. So you have to decide between where you want to register. Like, should I register in Delaware? Should I register in Florida? That's a very common question that we are asked by a lot of our clients. Where should I end up registering? Where should I end up incorporating? A lot of people say that if I register and start a company in Delaware, it has a lot of benefits. Or should I register in a state which doesn't have state tax, like Florida or Texas and all the stuff here? So whenever you're trying to start a business in India, you have to think of where to start and which state to start it in. Now, so selecting the state is an important issue. Now, when we advise our clients as to which state you should go to, we always ask them, where are you going to be based? Are you going to be based in Texas? Are you going to be based in California? Where are the majority of your clients? And that is the first most common advice that we give, that you should register in a state where you're going to be based and where you're going to have majority of your clients. So application and registration of a business starts at the state level. And of course, then there are tax considerations also. But when it comes to taxation, like even though I'm located in California, and should I register in California? Can I register in Delaware? We have what is called a nexus. A nexus is a sort of an agreement between all the states, which says that the state income tax should be split based on some nexus rules. So nexus rules means that, okay, we have a company in California, and but that company is selling its merchandise in Illinois or in Ohio or in New York. So the New York state comes along and says, why shouldn't we get a part of the revenue? So there is a nexus agreement between various states, which sort of decides, okay, how much revenue should be, how much state income tax should be paid to that one. So in very brief terms, we look at all these factors, like, where you should incorporate, where you're going to have your head office, where you're going to be your clients, are you going to distribute your merchandise all over America? So those things will help us pick up the state. Then we register a company, and there are various business structures, which is the next slide. We'll talk about, we register with that particular state and we incorporate in that state. So when you register in that state, you have to have, of course, have who are the officers, who are the directors, do they have social security numbers? Are they US residents? Are they US non-residents? So things like that. I can register a company in the United States without, by people from India. So registering a company is not an issue. You also have registered agents who would register companies for you, and they would lend you their address and all. So once a company is registered and set up in a particular state, and you get a state tax ID, you have to get a federal employer identification number, which is basically the tax ID number of that entity that you obtain from the federal. And one of the requirements for getting an EIN is that you should have somebody who's got a US tax ID number. It could be a social security number, or it could be an ITN number, individual tax identification number, because you will not be able to get an EIN number employer identification number at the federal level without having somebody with a US tax, an individual with a US tax ID number. And then, of course, the last one is also opening a bank account. About 10 years ago, you could virtually basically open a bank account through online mechanisms. But right now, I think with more strictness, they require you to be there for the first time. There are still some odd, very small banks like Mercury Bank, which would probably enable you to open a bank account without physically going into that. But in majority of the cases, your first visit has to be into the branch, where you have to take somebody with a US tax ID number to set up a bank account. So this particular slide deals with how you register a company. And basically, very simply, you have to register at the state level, and we would advise you, what state and all this stuff, depending on, your business, your clients, and all this stuff here. So next slide. Okay. Now, what kind of business should you set up? Now, in India, we have private limited companies, or we have public limited companies. So whenever we talk of limited companies, now, these are companies that pay their own tax. They are like taxing entities. So the government, if that company makes money, the company will pay the tax to the government. We have different kinds of business structures in the US. One is a C Corp. Okay, a C Corp, form 1120. That is the form that we use to file the C Corp return. Now, C Corps are very similar to private limited companies in India. The company is a person. The company can own the property. The company has to pay its own tax and all that stuff. So C Corp is very synonymous to a public or a private limited company in India, where the company handles all properties. The company pays its own tax. Now, in addition to the C Corp, we have other structures in the US, which are basically flow-through entities. Flow-through entities means the entity does not pay the tax, but the owners pay the tax. So what are those flow-through companies, or we call them pass-through companies? Pass-through companies or flow-through companies means that we calculate the profit of that entity, but the entity doesn't pay the tax. There are, of course, rules where a flow-through entity could pay the tax, like if it was a previously C Corp and now it becomes a S Corp, which is a flow-through entity, based on the retained earnings at the C Corp level, there could be some tax to be paid by the S Corp. But that's if there was an opening retained earnings balance. If not, then all these are flow-through entities. So firstly, we'll talk about, so C Corp is very clear, very similar to a private limited company or a public limited company in India. It pays its own tax. Then we have limited liability corporations. Limited liability corporations they're a flow-through entity. The entity does not pay the tax. The liabilities of the owners are limited to their capital contribution. Now, as soon as you set up an LLC, we don't have any particular form. An LLC is set up as a corporation, as a limited liability corporation, is a flow-through entity. Then you have to basically select or make an election that will that LLC file a return as a C Corp or as an S Corp or as a partnership, or is it a single member LLC? A single member LLC, there's only one holder. But all these are flow-through entities. So when it comes to LLCs, these are limited liability corporations where the liability of the owners is limited to their capital contribution, but you make an election to be either treated as a C Corp, in which case you file 1120. Now, in case you're 2 or 3 people who get together and form an LLC, now the IRS will automatically classify you as a partnership. So we have partnerships, 3 people as partnerships, unless you make an election to be treated as an S Corp. So coming to the third one, S Corp. Now, an S Corp is, so what is it? An S Corp is a flow-through entity. Flow-through entity, a corporation limited to shareholders who are less than 100, and the holders of S Corporation should be US citizens or citizens of Canada or America. So anybody from outside who's not a US citizen or a Canadian citizen or a Mexican citizen cannot open an S Corp, cannot make an election to be treated as an S Corp. Now, suppose, we have 3 people in the US who get together, set up an LLC, and they file an election to be treated as an S Corp. So we will file a return for the S Corp. It will be, and it's called Form 1120S. Like C Corp was Form 1120 and S Corp was Form 1120S. But the profit of that corporation will be allocated through to the partners, to the owners of that S Corp. So there are three owners. They will all get what is called a Form K1. A K1 form is basically a form which allocates the income of the S corporation to the owners. So one owner will get a K1, the other owner will get a K1 too. And so the owners of this corporation declare their share of income on their personal returns. So the personal returns are, you form, we have 1040 form 1040, which is for a resident. We have 1040 NR if you're a non-resident. So whatever is the income of the S corporation is no taxes paid by the S corporation. Through a Form K1 that is included on Schedule E of the Form 1040. And on that form, the income will be included on the individual return on Schedule E, and the individual will pay the tax. So that was for an S Corp. Now, S Corp, as I mentioned, is limited to people who are residents and citizens of United States, America, Canada, or Mexico. Now, when it comes to partnerships are, you can have individual. Okay, S Corp is also only limited to individuals also. You cannot have partnerships being shareholders of an S corporation. Now, when it comes to partnerships, you can have companies as partnerships. Like a C Corp can be a partner of a partnership. An individual can be a partnership. But again, the concept is the same, that a partnership is a flow-through entity. Unlike India. In India, if you have a partnership, the partnership pays the tax. But if you have a partnership in the United States, the share of the income is allocated to the partners, and they pay through K1, again on Schedule E, and the partners pay the tax. The third kind of entity is you set up an LLC, but it's a single member LLC. There are no two members. So that single member LLC is again a flow-through enterprise. We don't have to file a separate return for a single member LLC because the entire profit of that company is allocated to the owner, and it goes on Schedule C of his individual tax return. So number three, S corporations, partnerships, LLCs, single member LLCs are all flow-through entities. Now, to bring compatibility in the tax rates between a C Corp and flow-through entities. So like C Corps have a flat rate of 21%. So LLCs, S Corps, partnerships, single member LLC, they get what is called a qualified business deduction. So 20% of that income is allowed as a deduction, so that the tax rates are very compatible with the rates levied on C Corps. Sole proprietorship is, I register a small proprietorship, it goes on Schedule C. Then you can, you have other kinds of entities which are non-profit entities, which are basically, they don't pay tax, but there's a lot of compliance requirements for non-profits, because it's all public money, it's all tax deductible as donations on individual returns. So there's a lot of compliance on donations, how they come in and how it is spent. So a very detailed schedule on the expenditures compliance for non-profit. So keeping the states in mind, keeping where you want to operate, keeping who the owner is going to be, and what are the plans you're going to have, we will sort of navigate you to selecting the right kind of business structure and the most effective tax structure. So can you get the next slide, please? Yeah. Okay, we discussed all this. C Corp pays its own tax. It is deemed to be a person. LLCs, partnerships, S corporations, the owners pay the tax. Single member LLC, you pay the tax on. And there's gift and estate taxation. We'll cover that. Some US people in India might want to give gifts to residents of US. How does that work? US expat tax, like we have a lot of concessions of US citizens living in India, working in India, and all the stuff. And then we'll discuss about each one of this in more detail. And then we have the exit tax, like somebody wants to surrender his US green card or US citizenship. How is he connected, and what sort of tax compliance are are involved in all that. So we will go over that also, when we come to these individual topics. So can the next slide, please. Okay, so we'll start with taxation of non-profits. Basically, these are non-profit entities. Very, very briefly, I have registered non-profit in the United States, and that non-profit organization is called Radha Annpurna Charitable Organization. And the purpose of that organization is to basically offer free meals, free food. So I have set up a small nonprofit. It's a nonprofit of the US with one dedicated aim to provide free food in Vrindavan near Mathura. So we have that as already set up, but it's a US nonprofit, where anybody who contributes that profit gets a tax deductible receipt. They can reduce their tax income and comply with that. We have to fill out a form 990, which is basically a compliance form, which gives a detailed list of donations and list of all expenditures to make sure that they are in compliance with the general policy of the United States and are used for this non-profit organization. So can you go to the next slide? Okay, exit tax, like anybody in India who wants to surrender his green card and US citizenship. Like, there are a lot of people say that, I'm now living in India, should I really be paying into Social Security? Should I really be reporting all my assets on US tax compliances and all? So a lot of people come across, plans to surrender their surrender the US green card or citizenship. So for that, we require to fill out a form 8854. In very simple terms, I will be subject to US taxation if I decide to surrender a green card or US citizenship. And if you look at it in a very general manner, whatever I have today, it is assumed and deemed that I've sold it. Say I have properties, I have mutual funds, I've got stocks. So everything will be computed at the fair market value, and if it means capital gains, I'll have to pay tax on the capital gains. If it means dividend income, whatever, if it means gift tax and estate tax, I'll have to pay that also. So who is applicable, who is liable for this exit tax? Number one, anybody who's got an average, not everybody is liable. Like if you don't meet these conditions, then you don't have to file an exit tax. You just file your final return. So if your average tax liability for the last 5 years has been $178,000 annually, then you will have to file an exit tax. Or if your total net worth, which is the fair market value of all your assets worldwide, is more than $2 million, you will be subject to gift tax, to exit tax also. So these are the rules when you want to surrender your green card or your US citizenship, and you look at all the net worth that you have, you look at your previous tax returns, and if you meet any one of these categories, you are required to file an exit tax, which basically means value everything that you have to fair market value and be exposed to capital gains and all the stuff here. Get the next slide. Okay, US expat tax, US citizens file yearly return if they now people who come to the US, they still have to file US return. Now let's go back and figure out the mode of US taxation. Now, number one, like in India, we base our Indian taxation based on the number of days. So it's more like a residential period in which you are in India. If you're in India for 183 days and last 4 years, 365, and then 765 for 7 years, you are an Indian resident. And being an Indian resident means that you are subject to global income. So you will have to report your global income. Now in the US, we do base it on number of days also for sure. But in addition to that, if you are a US green card holder, or if you're a US citizen and you live abroad, even if you live for 5 days in the US, but you are in India, you've moved back to India and you're a US citizen, you are always a resident of US. Green card holder is always a resident of US. And being a resident of US means that you should report global income. Report global income, report all your financial assets. There are a lot of compliance requirements as to what you should report and what. So in very simple terms, being a resident of US means global income. And now to avoid, a lot of countries have tax treaties between countries, like, there's a tax treaty between India and US and those tax treaties are basically meant to bring parity to the taxation system, that nobody's paying tax to two countries. So we have tax treaties, which tell you very clearly that where do you pay your tax. Like if I go as a student visa, I go as a student to the US, then I'm always, even though I live in the US, in addition to being a green card holder and a US citizen, to become a resident, if you're in the US for more than 183 days, you are a resident. But under the tax treaties, we have, exemptions, like a student studying in the US is always filing a non-resident return. I'm in the US, but I'm attending college. I have a side job. I will only pay tax as a non-resident of US, which basically means I will pay tax on the income that I earn in the US. And if I have some income back home in India, it is not included on the US return because I'm filing a return as a non-resident. So then we have, the US government gives some concessions to US citizens, US expats working abroad. There's a foreign, you take benefits of foreign tax credit. So whatever taxes you've paid in India, suppose, I'm a US citizen, but I've moved back to India, I have a business here, or I'm working with an American company in India, and that American company, that Indian company is making me the money. So my first onus of taxation is to the country where I earn my money. So I file my return in India, I pay taxes to India. But being a US citizen, I'm also required to report global income. So I include my income on my US return, but I get a foreign income exclusion. So any US citizen, expat working abroad, provided he stays abroad for more than 330 days out of the full year, he's allowed an exemption of about $115,000 annually, which will reduce his US taxable income. So there's a foreign tax credit benefit, there's a foreign earned income exclusion benefit, and there's a foreign housing exclusion benefit. All these are given to US citizens working abroad. Can you next slide? Okay, so you expect tax, basically, you live abroad and you've never filed taxes. So, a lot of people, when they move back to India, they say that, I'm a US citizen, but I didn't file my US taxes because now I'm working in India, I'm paying taxes in India. So if you have that situation, I moved back to India 20 years ago and I've never filed a return in the US. Number one, are you required to file a return? And the fact is that whether you have income or you don't have income in the US, if you're a US citizen, you are a US resident, you're always subject to filing a return in US. Now, if you haven't filed it, the IRS does give you that opportunity to streamline. Streamline means basically go back and file 3 years of returns and say that, it was an oversight. I'm retired and I'm just living in India now. So, but you have some income in India. So you'll streamline and file 3 years of return and get back. But going forward, you'll have to file your returns. So the rules of all these exclusions that you have, foreign income exclusion, foreign tax credits, housing allowances, you have to be in India for more than 330 days and all the stuff here. So in case you've missed to file returns, to US returns, despite being a US resident, you have that option of, selecting that streamlined filing compliance procedures and all the stuff. You go to the next slide, please. Okay, gift tax. Now, gift tax, whenever we combine in the US, we combine what is called gift and estate taxes. So throughout my life, I'm a US citizen. I file and throughout my life, I've been helping my children fund their education in India, or I've been giving, some money here and there. So the total amount of gifts that you give, number one, the person receiving the gift never pays the tax. Okay. The recipient never pays the tax. The person giving the gift is also exposed to gift tax. Now, at this point, I'll just say that there are three kinds of taxations that we have in the US. Firstly, we have federal taxation, which, you owe money to the federal government. Then we have, which is income tax. We have income tax at the federal level. We have income tax at the state level. So I'm living in New York. I'll pay income tax to the federal government. I'll pay income tax to the New York state. And then I could also have local taxation. I'm living in New York City, so I could pay some taxes to New York City. That is one kind of taxation. The second kind of taxation is Social Security taxes. So everybody, on all your active income, if you're a US citizen, suppose running a business in India, you would be required to pay Social Security taxes to the US government on active income, like employment income or self-employed business income and all that stuff. So we have income taxes at the federal level, at the state level, at the local level. We have Social Security taxes, which are non-refundable. Now, Social Security taxes are taxes that you pay to basically get Social Security after you retire, which is age 65. And that Social Security is divided into two components. One is Social Security and the other one is Medicare. So the government pays for your hospital bills, for your hospital stay, that comes under Medicare. And Social Security also, once you meet the requirements, you get Social Security after you're 65. The rules of getting Social Security are basically you should have contributed into Social Security for 10 years, which is 40 quarters. So a lot of US citizens, when they retire, they come back to India, but because they worked in the US for more than 10 years and contributed to Social Security, so they get benefits of Social Security when they retire. So we have many people here who are living in India but getting Social Security for them. This is non-refundable. Like, income tax, if you paid more, you'll get it back. But once you contribute to Social Security, the only benefit that you have is that, after you retire, you'll get Social Security and you'll get free Medicare. So that is the second kind of taxes. And so one is income tax. The second one is Social Security taxes. The third one is the gift and estate taxes. Now, gift and estate taxes is the taxes applicable to very rich people who've got a lot of net worth and a lot of assets, but they're combined. So all the gifts that I've given throughout my life, plus all the fair market value of the estate value that I have, at the point of a person's demise, they calculate his total net worth, total estate. Say they calculate the fair market value of all his assets, and they see that if it meets a certain threshold and below, then you don't have to pay any gift and estate tax. But if it crosses a certain threshold, then you have to pay gift and estate tax. So at the last line, so the total value of the gifts and the estate value at the point of demise, it is $13.61 million. So if your total value of your estate and gifts given throughout the life are less than 13.61, you don't have to pay any gift and estate tax. If they are over that value, then you pay this tax also. So you're paying income tax to the federal level, to the federal, state and local. You are paying Social Security taxes, and then you pay gift tax, gift and estate tax if your total asset value plus gifts that you give are more than $13.61 million throughout the year. Now, there are certain exemptions. What is classified as a gift? Can I give something and not reduce my basically reduce my tax liability? So the government says that you can give to anybody $18,000 for 2024, and you will not be exposed to gift and estate tax. So I can give every year. I can give my child $18,000, and that will not reduce my 13.61 limit. You can so one is the if I'm below 13.61, which is the annual exclusion limit, I don't have to pay tax. If you give everything to your spouse, you don't have to pay tax, gift and estate tax. If you use that money and pay it for education or medical expenses, you are not, it doesn't reduce your 13.61. And if you give money to charities and political organizations, then also you don't have to. But anything else that you give out, like suppose if I give somebody $50,000, I'll have to file Form 709. Now, what does that Form 709 really do? It tells you this is the total amount of gifts I've given in this particular year. That amount will reduce my limit from 13.61 minus 50,000. So I will keep on reducing my gifts over $18,000, and my limit will keep on going down. And then at the point of a person's demise, what they will do is they will calculate the fair market value of all his assets and liability, all his assets minus the liabilities. And if they come to more than 13.61, he'll be exposed to this additional tax, which is additional to income tax, additional to social security sectors. He'll have to pay an additional tax like gift and estate tax, which is where the tax rates are very, very high. They're as much as 40%. So that is about gift and estate taxes. Yeah. Let's get to the next slide, please. Okay, now, so this is all about entity structures, what kind of taxations we have. Of course, when it comes to taxations, we have scales. Now we have, slabs. You pay 10% if your adjusted gross income is this much, you pay that much, 20%, 22%. We have slabs. Now, the other thing is that there are special rates for capital gains on in the US. Now, we have three categories of capital gains rate. Either I can pay 0% capital gains, or I can pay 15% capital gains tax, or I can pay 20% capital gains tax. It depends on your slab. What is my total adjusted gross income? In very simple terms, if I'm in the first two slabs of my adjusted gross income, then I don't pay any money to on capital gains. If I'm in the third slab to one before the highest slab, I pay 15%. Or if I'm in the highest tax bracket, I pay 20%. So these are on capital gains, and there are other items also. If I've got collectibles, the rate is 25%. So there are these are for individuals, but for corporates, the capital gains and the income tax rates are the same. So those are the rules on capital gains. Now, even the kind of income we have, losses, how do I adjust my losses? Now, there are various kinds of income, so which I'll just brief you. I have got income from active business. Operating active business is employment income is active income. I'm working for somebody, I'm getting a salary, I'm getting a W-2. That is active income. I'm self-employed. I run a business in India. That is active income. So social security taxes are applicable only on active income. So now we call that operating income. Now, if I have an operating loss, what are the rules on that operating loss? I can offset my entire operating loss against any kind of income, against my wages. Say I run a business in India or anywhere else, even in the US, and in my business I make a loss. But I also have a side job where I'm making a salary. I can adjust my loss in my business against my salary. Then we have passive income. Like, when you're not fully involved in the business, like you have a rental property. So you have a rental loss, or you have a partnership loss and all that stuff. So the rules on passive activity losses are that they can only be offset against passive activity gains. And in the final year of disposition, like close my partnership down, I'm a passive partner in a partnership. So every year I'm making a loss, I cannot take benefit of that loss. But the minute I surrender my partnership and get rid of it, then of course in that year of sale, I can offset my passive activity losses against other income. So active income, operating income can be offset. Operating losses can be offset against any kind of income. Passive losses can only be offset against passive income. And then there are carry forward periods. And then we have Rental income, like rental, I own a property and I've rented it out. So there are rules on, again, rental property. It's a passive activity, but you're allowed a allowance of $25,000 to adjust against other income. So so because of the nature of the kind of types of income, the rules on the loss carry forwards will vary. So this particular slide is, so that was about losses and all that stuff. It has nothing, okay, in addition to these taxes, income tax at state, federal level, with social security taxes, gift and estate taxes, we have other taxes which are like sales tax. Sales tax is a consumption tax. It's a user tax. Wherever I'm based in California, but I sell all my merchandise to New York. So where do you pay your sales tax? You will collect it on behalf of New York State, and you'll pay it to New York State because your items are being consumed in New York. So we have, the sales tax compliances that we have. So basically, sales tax is not a tax on income; it's a tax on consumption. So if your goods are consumed or your services are consumed anywhere else, you will pay taxes to that state. And under the rule of nexus, again, in nexus, I said that if you have, let's try to have a clear understanding on nexus. I'm a company that is registered in, say, California. Okay. And I'm a manufacturer based in California. I pay I sell my merchandise maybe in 5 states in the US. I sell it to, Florida, to other companies and all this stuff. Now, the rule of nexus says that, should I pay taxes to Florida? So how do I determine whether I own any tax liability, which could be income tax liability, which could be sales tax liability also? So should I pay a part of my state taxes collected to Florida where I'm selling my merchandise? So a person is considered to be liable for taxes out of his state of registration if he has a office or a structure in the other state. Like, I'm a California company, but I have a sales office in Florida. I'll be liable for Florida income tax at the corporate level. At the individual level, it is a tax-free state. If I have a contractor, an independent contractor, I've employed 2 people in Florida who are marketing for me and they're selling for me, I'll be liable for income taxes and sales taxes and all that. Or if I do local marketing, I market on social media or in Florida or in ads and all, then I'll be liable. If I don't have any one of these, then I'm not liable to pay income taxes or sales tax. Sales tax is, of course, a consumption tax. You'll have to pay where the goods are consumed. But income tax, if I don't have a physical office, I don't have independent contractors, I don't advertise directly, I do all my marketing through a web-based system out of California, then I'm not liable for Florida income tax. So the whole determination of whether you're a part of Nexus, whether you're not a part of Nexus, whether you should register in a particular state. If you are selling for sales tax, you'll have to register where you are consuming. So that was all about, the various kinds of taxes. Now, compliancing, when do you file them? For all flow-through entities, which are your partnerships, your S corporations, the filing deadline is 15th March. Okay. For your C Corp and individuals, the filing deadline is 15th April 2024 for the previous year. Like we're talking of filing the return for 2023. So if it is an S Corp, remember, as we discussed earlier, all the flow-through entities don't pay the tax, but a return is still to be filed. So we file a return for the S Corp, for the partnerships on 15th April. We get a Form K1, which allocates the income to the partners or the owners, and that is filed on the individual return, which is due on April 15th. So you have to file an individual return, which is Form 1040. For S corporations, it is Form 1120S. For partnerships, it is Form 1065. For individuals, it is Form 1040. And for C Corps, is Form 1120. So the deadline for filing the returns is 15th April 15th April for the 23 return for individuals and C corporations. For gift and estate tax, it is 9 months, 15th April 24. Now, if I'm a US citizen living in India, I automatically get a 3 months extension to file. So my filing deadline for the extension to file the return will be June 15. And then, of course, you can file an extension. Like for all the flow through entities, you get an automatic 6 months extension, which is from 15th March, you go to 15th September. Now, filing an extension means filing an extension to file a tax return, not to pay any tax dues. All your tax dues should be fully paid before on the filing or the original filing deadline of March 15th. Now, the other question that a lot of people come is that how much should we pay? What are the installment payments that we should do? So there are very specific rules for what are your advance payments that you do. In very simple terms, I should pay taxes equal to 100% of my last year's taxes, or if I earn over $200,000, then I should pay it on 100% of the current year's estimated taxes, and you should pay them quarterly. So all advance taxes are paid up in April, June, September, and January. So all your taxes for 23 should be fully paid by January 15th of 24, but not in the last installment. They should be evenly divided between all the 4 installments, like April, June, September, and December. If you don't pay them, there are penalties. There are interest charges for underpayment of taxes. And if you don't, so there are 2 kinds of penalties that we have. Number one, the first penalty is for not filing a return. Not filing a return on the due date. Suppose if you don't file it on the due date, but you filed an extension, you don't pay any penalties. So one is not filing the return on the due date. There's a penalty for that. And the second penalty is penalty for underpayment of taxes, both at the federal and the provincial levels and all this stuff. Okay, 15th October is the extension for that one. And all individual returns, all the payments should be done by by January 15th for the previous year and all. So these are just deadlines as to when you should file your returns and what kind of penalties are attracted if you fail to file your return or you fail to pay your taxes evenly throughout the year. So underpayment of tax filing penalty and late filing penalties. So these are 2 kinds of penalties we have. Take the next slide, please. Okay, at the state level. So those were your compliances at the federal level. Okay, so there are other compliances at the federal level in pertaining to payroll, which we'll discuss that. So in addition to meeting these filing requirements of federal returns and all, we have same kind of filing requirements at the state level. So in addition to that, we have to file an annual report to every state. So I registered my entity in Texas. I have to file an annual report. An annual report is due on the 15th day of the 3rd month. So what is this annual report? It tells you who are the owners, has there been any change in ownership, who is the officer, who is the director. That's all kind of reporting that comes under the annual return, and that one is due. Now, secondly, you'll also pay franchise tax. For having a company in that particular state, there's a franchise tax which is calculated based on your issued capital or on the total assets that you have. So and then of course sales tax compliance. Sales tax is payable to the state where you're registered. So that is the next kind of compliance that you have here. So those are at the state level. At the state level, an annual return, a franchise report, and if sales tax is applicable, filing the state sales tax also. Next one. Okay, go to the next. Okay. Now we come to payroll taxes. Now payroll taxes are basically, all employers are required to withhold taxes for federal, state, and local taxes. And so those are income taxes. In addition to that, we have social security taxes, which are also, so to social security, the employer contributes and the employee contributes. So the employer will hold income tax at the federal level, at the state level, at the local level. And he will also deduct the employee's portion of Social Security and Medicare. Now, and the employer, for Social Security, the employer contributes the same amount. So Social Security taxes are basically taxes that are non-refundable, but you get Social Security when you retire. So those are 6.2% of your income, which is your Social Security taxes, and 1.45% of your income, which is your Medicare expenses. Now, if I'm earning more than $200,000, my Medicare portion goes up by 0.9%. So these are all contributions you do to Social Security to take benefit when you retire. So we strongly advise our clients, who are planning to move back to India or leave the United States, to make sure that they have contributed for at least 40 quarters to Social Security, which is 10 years, so that when they retire, they'll be able to get back some Social Security for the government. The employer, not the employee, the employer also pays taxes for workman's compensation, which is 6% of the employer on the first 7,000 that they pay. So Social Security is paid both by the employer and the employee. Income taxes are withheld for the employee by the employer. So the employer has an obligation to remit that money to the federal and the state governments. The workman's compensation, if you meet certain number of employees in your organization, you're also required to contribute to workman's compensation and unemployment taxes. So these are all the liability, not of the employee, but the employer. So this was about the federal and the payroll taxes that we were talking of. Okay. As I mentioned to you, there's a lot of foreign reporting. I'm a resident. I have to report all my assets, all my financial assets held outside the US. This is under the Foreign Act Tax Compliance FACTA. So you use Form 8938 to report everything that you hold outside United States, in terms of assets, in terms of bank accounts, in terms of signing authorities, ownership in companies. That is all given on Form 8938. Next slide, please. Okay, so for financial, what should I report? What is classified as a financial asset? So basically, all your stocks, bonds, investments, other securities, your signing authorities, your bank accounts with more than $10,000, ownerships and partnerships, ownership in companies are all considered financial assets to be reported on Form 8938. If you own a property, you don't have to report that. Next slide, please. Okay, Form 5471, this is for corporations. Certain US citizens and residents who are officers, directors of companies should report that on Form 5471. So this is a form, if you have ownership in a company of more than 10%, you have to report that I have shares in a company in India and I own more than 10%. These are very strictly enforced compliance requirements, which every US citizen has to form. So if a US citizen owns more than 50% of an own corporation and has 10% shareholding, he's required to fill out a form 5471. So 5471 is strictly ownership in companies, in corporations. Can you go to the next slide? So this requires you to give all the assets, all the ownerships, how much interest you have, and there are detailed filing requirements, but huge penalties if you fail to do that. Next one. Form 5472 is required information on US corporations with 25 direct holdings of foreign and domestic related party transactions. So if you have transactions where I own 25%, you are required to again report all that stuff here. So can you go to the next slide? Okay. Now 8865 is if you have ownership in a partnership. If I have a 10% interest in a partnership, I'm required to file 8865. And this goes on 15th of April of every year. Can you next one? But 8621, this is a US tax returns, is very critical component. So this is basically, this is a very important form for individuals. And there are very stringent requirements of what should I report. And the biggest issues that a lot of individuals have is when they have, of course, if you have more than $10,000, you have to report them. On 5471, I have more than 10% shares in the company. On 8865, I've got ownerships. But this is individuals having assets. So over 10,000 FBAR, all your bank accounts have to be reported. Now, if you have mutual funds, which basically mutual funds means that you are investing in a passive foreign investment corporation. I have mutual funds through ICICI, Prudential, or maybe Reliance Capital and things like that. I have to report them. I have to report them. Now, mutual funds has a very strict reporting liability, which we will discuss about how do you report mutual funds. So there are three ways in which a passive foreign investment corporation is taxed. An individual is taxed if he has got an investment in a passive foreign investment corporation. We advise our clients to get out of mutual funds and open a demat account, do self-trading. So what is the difference between this PFIC and self-trading? Now, self-trading, you only pay taxes upon disposition. When I sell my stock and I have capital gains, I pay that. But if you have investments in a private foreign investment corporation, the US government gives you three choices. Option one is election to mark to market. Now, mark to market means what? Say my net asset value of my investment at the beginning of the year was, say, 10 lakhs of rupees. At the end of the year, my assets have grown up to 20 lakhs. So US government requires you to pay taxes and report that gain, notional gain. I haven't sold my investments in the mutual funds. That notional gain of 10 lakhs becomes taxable in the US. So that is option one. So and technically, because these are stocks owned in Indian companies, you are liable for taxation to India. But under this mark-to-market rule, you have to end up paying taxes to the US based on the notional gains. So we advise us clients, to get out of mutual funds and open up demat accounts and all this stuff. Can you go to the next slide, please? Okay. Option two is that, qualified electing fund. So you qualify electing fund and you differentiate between capital gains and ordinary income. And what is again, what is ordinary income? What is capital gains? All mark to market. Like, if my net asset value was 10 lakhs in the beginning and 20 lakhs at the end of the year, that 10 lakhs is ordinary income. Ordinary income means I'm taxed on my ordinary rates. So I'm in a graduated scale, 10%, 12%, 22%, 24%. Capital gains, as we discussed, we have only three rates. So 0%, 15%, or 20%. So under this election to treat as a qualified electing fund, you can basically choose whether you want to be taxed on a capital gains rate or the ordinary income. And then, of course, the last one will be on any excessive distribution that you have. There'll be, excessive distribution tax and also. This is the default method if you don't make any selection. So in very simple terms, there are a lot of reporting compliances that we have to do. Ownerships in companies, ownerships in partnerships. If you have more than 10%, you have to report ownership. Then bank accounts. If you have signing authorities, your officers and directors, you have to report that. And for mutual funds, there's a mark-to-market and all these elections you have to report. And if you don't report them, they have heavy penalties for that. Go to the next slide, please. So now we come to the fact that, now you understand about the kind of structures and the taxes that you pay. Now, a lot of companies, startup companies and other companies, they want to take advantage and make sure that they're not paying extra taxes. So first we discussed about foreign tax credit. So, I'm a company that I'm a US company, but I have a branch in India. So I'm required to add that income to my US return, but I will be able to claim foreign tax credit. So all my taxes paid under the treaty in India will be claimed as a credit on my US taxes. Now, the way foreign tax credits work is, it is not a dollar to a dollar. Like, say, if I pay $20,000 of taxes in India, will I get a $20,000 credit on my US return? The very simple formula for calculating how much is my foreign tax credit depends upon how much is my foreign income versus how much is my global income multiplied by US tax liability. So it might not be equal to $1 to $1. So that is how you calculate foreign tax credit. We discussed about foreign income exclusion. A foreign income exclusion that, if I'm an expat or a US citizen working abroad, $115,000 is non-taxable in US. But you pay the taxes in India, where the rates could be higher. Now, for also working outside US, you get a housing exclusion. Then there are principal residence exclusions. I'm a US citizen. I've moved back to India, and this is how. I'll give you one example. Say I had a house here, and I sold that house. I put all my capital gains money and my principal capital account into government savings bonds. So I deferred. I basically exempted myself to paying any taxes in India by investing in government bonds here. But because this was my residence, and residence means I lived in this house for more than 2 out of 5 years. In the last 5 years, I got an exemption of $500,000 of capital gains. So that is an exemption I get for the principal residence exemption. Then there is a research and development tax credits that you get, and the employee retention credit that you get also. So can you go to the next slide, please? Okay, employee retention credit. During COVID, the government, a lot of companies, and we've done this refund for many companies. So during the COVID time, the government extended a lot of benefits to companies. One was the payroll protection program. So you retained your employees, and per employee you would get $7,500. So people took advantage of that one. Now, the payroll protection program was further extended under the Disasters Act into what is called an employee retention credit. So now it's not a credit anymore. What a credit is something that reduces your tax liability. Now it's the employee retention refund. So what it said was that if during COVID, you still retained your employees in the years 2020 and 21, and there was a decline in the business, or even if there was not a decline in the business, you faced hardships by virtue of supply chain issues, or you could not attend selling marketing meetings because there were restrictions as to how many people could get together for a meeting. So you could still be eligible for employee retention credits. And we've done this for a lot of companies. So that credit relates to the year 2020 and 21, and it is $26,000 per employee. Now, because we, like anything, we have a statute of limitations. Even for filing your returns and claiming refunds, we have a statute of limitation, and which is basically 3 years. Now, so Q1 of 2020 expired on April 15th of 2023. So nobody can claim that quarter anymore. Q2 of 2020 expired on July 15th of 2023. Q3 of 2020 expires. This is already expired also now on October 15th. So right now, you're only eligible for last quarter of 2020 and first 3 quarters of 2021. But you're still lucky. You can still get up to $26,000 per employee, because the way the employee retention refund is calculated is you get $5,000 or $5,000 per employee for any one of the periods of 2020, provided you meet these conditions. There was a decline in revenue, or you faced hardships. So for 2020 Q4, you could still claim $5,000 per employee. Okay. There are some adjustments that you have to do. Suppose you got a payroll protection loan, or there was things like that, those could be adjusted. But the way this whole thing is structured is that even with payroll protection loans, which were forgiven by the government, because these amounts of refunds are very limited to 5,000 per employee, you still are not duplicating. You're not getting refunds from two places on the same wages. So we do all that analysis, and we calculate, and maximize your refunds here. So the rules for 2021 are different. You get $7,000 per employee per quarter. So for the first 3 quarters, quarter 1, quarter 2, quarter 3 of 21, you will get $21,000 per employee. And quarter 4 of 2020, you'll get $5,000 per employee. So 21 plus 5 is 26. So come January 15th, 24, if you file your claim after that, you will lose 5,000. So your 26,000 will be reduced to 21,000. And we on all these refunds, we work on a contingency mechanism. Basically, if we recover money for you, we take a percentage, which is 12% of whatever we recover. If we are not successful, we don't claim anything. You don't have to pay us anything at all. And a lot of companies have taken advantages of this. So can we go to the next slide now, please? Okay, research and development tax credits. What is R&D? There's a very specific definition of research and development. Anything that is experimental, you don't have. It's not. You're still testing the feasibility of that project or that software or that product and all that stuff. It is not marketable. So all expenditures up to that point of feasibility are classified as research and development tax credits. And the government gives you a tax credit for all your R&D costs. A lot of companies fail to claim the R&D tax credits. So of course, there's energy tax credits. There's so many credits. So we analyze the client's profile and see, and try to determine that these are the credits that are applicable to you. So you get approximately 13% of whatever and that includes payroll costs also. I've got 5 people who are working on this project, and they're into development and designing a product and all, and it's still in the feasibility stage. I can claim 13% of that expenditure. So that is one. Now for the years 2016 to 22, the maximum R&D credit was 250,000, and it was doubled to starting from 23. It was doubled to a maximum credit of $500,000. Who qualifies for this R&D? Anybody who's got any expenditures relating to feasibility, and once the feasibility stage is over, then of course it doesn't classify as an R&D expenditure and all the stuff here. Can you go to the next slide, please? Okay, so how the R&D calculated? So you calculate, there are different methods. You calculate the total expenditures for the last 3 years. You take an average, you multiply that by 50% of your credit base, and you multiply that by 14%. So in very simple terms, up to 6 to 7% of your R&D expenditures, you can get that much as a credit from your tax liability. Can you get the next slide? Lastly, very, very important, and lot of people don't know about this, or they don't know how to go about it. Financing options. Businesses trying to enter into the US, businesses already operating in the US, and they need some money, they need some working capital, and they're trying to set up operations. And so we help small business owners obtain business financing by preparing, comprehensive plans. We have the Small Business Administration, the same organization, which is a government agency, which handles all this refunds and payroll protection programs and all. That SBA agency also has an arm under Section 7 to extend business loans to companies. So those loans can range from $50,000 to $5 million. And the loan rates are at preferential rates. They are lower than the market rates. This is to encourage small business in the United States. So we help you with all that. And if you suppose you don't have any success with SBA, mostly in SBA loans are much easier to get provided they look at last 3 years of returns and all the stuff, which all that preparation work we do and we help you out. If that's not possible, you are a new startup, then of course there are private lenders also, and private lenders and banks, and we help you with all that. Can you go to the next slide? I think that was all I had to say about setting up in the US, the kind of structures that you have, the kind of taxations you are exposed to, income tax, gift tax, estate tax, social security, and exit tax, all that stuff, and then compliances at the federal and the state level, and the financing and the refund options that you have. So any more questions that you have, we can take those up, or if you have any questions, in general questions, we can address them also.
Yeah, so Mr. Sharma, quickly, though we are very much on time, thank you for giving such a detailed session, and discussing each and every law provisions, structuring opportunities and everything minutely. I think few people have asked, what about the SaaS-based startups, in US? If I think we have short of time, maybe we can answer later. And people have, asked for the copy of presentation, which we can share. And the people are asking whether the scope of Indian lawyers or practicing advocates in US or Canada. So they're looking for opportunities outside. So thank you for your time, for giving us so much of information. I think you've shared your coordinates. People might get in touch with you separately as well. So thank you once again. Now I hand over to Mr. Karna to have a concluding remarks, as we have 3 minutes left before we conclude this session.
Akhil, I echo your sentiment, Mr. Kris Sharma. Thank you so much. You've given a comprehensive view of how to set up and scale business in the US, the tax rules, the credit rules, and where to find the finance. And of course, they all know where to find advice and guidance now. So that's all good. And really, really, this was very informative. Thank you for your guidance and comprehensive coverage of the topic. And to Mr. Akhil Chandna, thank you so much for getting us such an esteemed and knowledgeable speaker. And with that, I hand it back to the the coordinator. And Neeru, would you like to take over? Thank you.
Thank you so much for joining us. Thank you, Kris, for giving us such a informative information. And we will get back to you to have a physical event also shortly.
Yeah.
Thank you.
Thank you, sir. Thank you, Akhil. Bobby, thanks to all.
Thank you. Take care.
Thank you, Arun. Thank you, Nikhil. Thank you, Neelu. Thank you for this opportunity.
Thank you.
Have a
Bye.
nice day, everyone. Thank you. Bye.
All right. Thank you. Any questions?